Walmart and Amazon are quietly exploring a major shift in how they move money. According to reports, both retail giants have considered launching or using stablecoins, digital dollars backed by US debt. This could save them billions in card fees, bypass Visa and MasterCard, and give them direct control over payment systems. But here's the problem. These stablecoins may not be as safe or as stable as they seem. A stablecoin is a private digital token pegged to the US dollar. You give the issuer $1 and you get one coin. But that dollar isn't held in cash. It's typically invested, mostly in US Treasuries. That means your digital dollar isn't backed by money. It's backed by market-traded debt. Debt that can lose value when interest rates rise. Walmart and Amazon process billions in transactions every month. And card networks like Visa and MasterCard charge steep fees. Stablecoins could help them bypass those networks entirely, settling payments instantly and cheaply while keeping full control over the transaction rails. That's why Walmart has lobbied for the Genius Act, a bill in Congress that would legalize private stablecoins in the US. If passed, it could trigger a wave of corporate-backed digital money. But here's where it gets fragile. Stablecoins are short-term liabilities, redeemable at any moment, but they're backed by long-term assets like treasuries. If rates spike and enough users want out, issuers may have to sell those treasuries at a loss. That creates redemption spirals. It's the same mismatch that broke Silicon Valley Bank, investing long-term while funding with short-term liabilities. And just like SVB, if confidence breaks, the system can crack. Even if stablecoin reserves are legally segregated from the company's balance sheet, that still doesn't make them dollars. They're not backed by the US government. They're not FDIC insured. And they're backed by debt that loses value in volatile markets. Most users draw an equal sign between stablecoins and US dollars, but that line isn't as straight as it seems. But in truth, they're holding a short-term corporate claim, backed by long-term public debt, with no guaranteed government support. And in the wrong moment, that misunderstanding could trigger a liquidity crisis. The Genius Act aims to regulate this space, including requirements for reserve segregation and monthly disclosures. But legal experts warn, even if reserves are technically segregated, redemption rights aren't always guaranteed in bankruptcy. If an issuer fails, courts may still treat stablecoin holders as unsecured creditors, though this remains untested legally. So is this really digital cash, or just another promise that only works until it's tested? And we've seen what happens when a stablecoin breaks. In 2022, Terra USD, an algorithmic stablecoin, collapsed completely. It lost its peg, triggered over $40 billion in losses, and panicked the crypto market. Even asset-backed stablecoins can crack. Redemptions can force bond sales, especially during volatility. This risk remains hypothetical for now, but it grows as stablecoins scale. US Treasuries used to be called risk-free assets. In May 2025, Moody's downgraded US debt from AAA to AA1, citing rising interest costs and unsustainable debt growth. That means all three major credit agencies, Moody's, Fitch, and S&P, no longer give US bonds the top rating. Bond markets reacted fast. 10-year yields surged above 4.5%. 30-year bonds briefly topped 5%. If stablecoin issuers are forced to sell into that volatility, they could amplify pressure on the Treasury market and expose how fragile risk-free really is. And here's the loop. The more stablecoins are issued, the more treasuries are bought. That helps the government raise funds. That money then flows into the economy, driving more transactions and more stablecoin demand. It's a private sector expansion of money-like assets, backed by public debt, but without central bank control. And the interest earned on those treasuries? It goes to the private issuer, not the user. Some analysts speculate that future regulation could revisit this, but today, the structure is largely unchallenged. Most countries aren't pursuing this model. Japan allows stablecoins, but they must be backed by cash, not treasuries. India, Brazil, and China are building central bank digital currencies, public money with no redemption pressure. The US stands nearly alone in allowing private firms to issue tokens backed by government bonds. It's a bold experiment, one that hasn't been globally replicated yet. When news broke about Walmart and Amazon's stablecoin efforts, Visa and MasterCard stocks dipped. Because if mega retailers control the payment rails, Legacy card networks lose leverage. This isn't just fintech innovation. It's a structural shift in who defines money and who earns from it. Even the Federal Reserve faces a version of this mismatch. It holds trillions in long-term bonds, but now pays over 5% interest to banks on reserve balances. That's created record operating losses for the Fed and underscores how fragile balance sheet structures become when rates rise. Private stablecoin issuers may be walking the same path, only without the Fed's ability to print money. Stablecoins may feel like digital cash, but they carry real risks tied to interest rates, market liquidity, and redemption surges. Walmart and Amazon are doubling down. Congress is still writing the rules, and users, for now, are trusting the system. But trust isn't insurance, and stability isn't guaranteed. If you found this breakdown helpful, subscribe to Global Notes by JP. We don't just summarize headlines, we go deeper into the systems behind global finance, the risks no one's talking about, and the power plays shaping tomorrow's economy. Like the video, drop your thoughts in the comments, and share this if you think others need to understand what's really going on with stablecoins. This is Global Notes by JP, where money meets meaning.